Hi, thanks for joining me on another Coffee with Waymark. Today's episode, we're going to take a look at a white paper that LPL recently published, which I think has some really fascinating tidbits in there about this upcoming 2024 election. So let me start sharing that right now, and I'll walk you through the parts that I actually found most intriguing and enlightening. So let's start here. This is just the cover, the title page. This is something that I'm sure all of the CNNs and the Fox Newses of the world will highlight ad nauseum, because ultimately they love using their little finger pointers and moving the charts and graphs around. But ultimately, you can see where the electoral votes look like they are right now, and then the 93 that are in the middle that are what we call the swing states. Next page is just a timeline of how crazy the 2024 election season has been. With everything from Joe Biden dropping out to the debate to all the way through January 20th, which ultimately will be the inauguration and hopefully a peaceful transfer of power. This third page or fourth page of the white paper actually talks about the fact that the U.S. stock market has actually been quite accurate in predicting the future president. And what this is pretty much saying is that 20 out of the last 24 presidential elections have been accurately called, and the incumbent party has won when the stock market is actually positive. Right now, as we sit here today on October 1st, we actually have a positive market, which is a good sign for the incumbent party, i.e., Vice President Harris. However, there have been 4 times where it has not been accurate over the last 20 years, and you can kind of see that all here. That right column here, you can see that back in the 50s, there was one that wasn't accurate. The 60s with Nixon was not accurate. Ronald Reagan in 1980 was not accurate, and then Joe Biden not accurate either. But the stock market was right 20 out of 24 of the last times. This is just so the next page is talking about how volatility is higher in an election year. We use this metric called the VIX, V-I-X, to measure volatility. And you can see that in an average year, that's the blue line. The blue line is pretty much how volatility increases or decreases throughout the year. You see a little bit of a spike at the beginning, right around March, April, another spike right around September, October. But in presidential, or I should say election years, that's the orange line, you see big spikes at those same times. So again, no big surprise there, but it does show you that volatility every 4 years kind of creeps up, especially when it comes to presidential elections. And it makes sense. At the end of the day, the stock market does not like uncertainty. And when you have, the ruling person who is, for all intents and purposes, the most powerful person in the world potentially changing, that impacts a lot of things. And in addition to that, this year, I believe it's every House of Representatives seat is up for grabs, along with a number of Senate seats. So not only do you have the president, Congress is up for grabs as well. And so that's what has led to this increased volatility. This is pretty much just simply saying that the stock market tends to do well after an election. Again, going back to the uncertainty thing. Now once a president is installed and is elected, typically, again, outside of a couple recent episodes, the transition of power has happened pretty quickly. Obviously, one of the bigger ones that we think back on is the early 2000s with Bush and Gore. That took a couple months for it to actually get sorted out, and therefore the uncertainty in the stock market was unstable. This is something pretty much saying that if one of the places that people go to when the stock market is volatile is bonds. And this may be particularly a good year to think about bonds, especially if you're concerned with the volatility, in light of the fact that bonds typically perform, they're not necessarily perfectly correlated to stocks. So if stocks go down, oftentimes, historically speaking, the bond market goes up. And now with interest rates coming down, that's also another thing that pushes bond prices up and therefore makes bonds pretty attractive. So they have a full page in the white paper about whether or not to increase your bond exposure in the portfolio. This is a really neat chart because, again, I know that that the news is very hard to trust, but this is a very unbiased way of looking at the Republicans versus the Democrats and how they look at some pretty important election topics like China, like immigration, like energy, like taxes. And then furthermore, they get into another section here where, you know, which sectors of the market would do better under a Trump presidency versus a Harris presidency. And then the final section here is on tax policy. And with a big giant asterisk on this, at the end of the day, the president doesn't act totally independently of Congress. And therefore, while all of these tax proposals are out there, and certainly Harris and Trump are campaigning on these tax promises, at the end of the day, they have to push it through Congress, and there's no guarantee whether or not anything that's listed here will actually become enacted. So as I mentioned, and they, of course, they have a what to do here, and I think it's a pretty, pretty general way of looking at it that yes, volatility increases, but if you're a long-term investor, there's no real need to make any major shifts in your asset allocation. So again, I thought this was an excellent piece that LPL put together, and one that, if especially if you're a one of these people that really follows politics closely, I think it'll be a very interesting read for you. So thanks for joining me on this Coffee with Waymark, and remember to be well and do good. Thank you.